the question is, do you believe that you need to change your style? You are bottom up, you look for 20-25% growth over 3-4 years into every business that you do, and you largely bottom up investor. The sectoral view comes later on.
Yeah.
Do you need to change your style for the next 2-3 years, or you don't feel the need? You're confident that that style will pay off dividends?
Yeah, I mean, see, as a small cap investor, you have to take a longer term view, right? So someone coming into the market anyways needs to have much longer term view. There are many periods in history, in the past, where markets have not delivered returns for sometimes 4 years, 5 years, 8 years, right? And hence you need to have a much longer term, 5, 7, 8 years kind of view. And it's even more important in the small cap space because they tend to be very volatile, mainly from a liquidity perspective. When money flows out, to get out of those stocks, the impact on prices is way higher than what you can get out from the large cap stocks, and that's where they turn out to be riskier. So if you end up coming at the peak of the market and then they go down by 30-35%, to recover sometimes it can take much longer time. So you need to definitely have a much longer term horizon. Given that we have longer term horizon, I mean, you can't, because you can't time these kind of things, right? I need to think longer term. Now, again, you can't just base it on assumptions that, okay, this is the strategy that I need to go for, right? If you look at historical sort of, 10 baggers, sometimes 10 baggers are easy from the bottom of the cycle. If you picked up many companies, say in March 2009, you would have a lot of multi-baggers. Or if you picked it during COVID times, you'll have a lot of multi-baggers. But that's not the real way of analyzing, because those times are going to be 1% of your total duration, right? You don't get those opportunities. And you need to look at what kind of companies really deliver multi-baggers from the peak of the cycle. So I looked at, say, 2008 peak of the cycle, which is about 16 years, before us. What kind of companies delivered multi-bagger returns? 10x plus. Not in 10 years, which is what we target, but still in 15, 16 years, let's look at the companies which have delivered 10x kind of returns, right? So the most common factors, which are present in these companies, one is high sales growth. So I looked at the top 500 companies or a little more, and then divided them into 10x companies and the non-10x companies.
Okay.
Right? The 10x companies, the sales growth was higher. So the average sales growth was 15%. For the non-10x companies, the average growth was 10%. Right? Total sales growth was about 11%. So last 16 years sales growth is that. Right? So that's sort of the longer term growth rate of India. Right? The second most important factor was the starting ROE for the 10 baggers was about 25%. For the in 2008, remember the ROEs were very high.
Yes.
Across the board.
Yes,
so hence, these numbers are much higher. It was 25% for the 10 baggers.
10x,
and the rest was about 22%. Right? But the sustainable ROE today, the ROE for the 10 bagger has gone down to 19%. For the rest, they have collapsed by almost 30-40%.
Okay.
Right? So sustainable ROE, not just the top line growth, but sustainable ROE is one of the most important factor which contributed towards the 10 bagger. The third biggest factor was, of course, starting valuation was lower for these, not by too much, but at least 15-20% lower than what it was for the non-10 baggers. One more thing was the starting valuation. And these are the top, maybe 600-700 companies of India at that time. The starting valuation, average value or market cap of the 10 bagger was 3,400 something. And then the starting valuation for the non-10 bagger was 10,000 crores. Right?
The market cap.
Market cap. Meaning that the starting market cap itself was much lower. So these are the long-term factors, is that high sales growth, high ROE, sustainable ROE, and low valuation plus low market cap. Those are the companies who become 10 baggers, right? So that's what we look for. Because if you are looking for 20-25% kind of a returns, they need to grow their bottom line by 20-25%.
True.
Those kind of parameters you will not find in large caps. because the top line growth for India is just 10-11% across the universe, and you're looking for almost double of that in terms of profit growth. And large cap makes up for India's GDP, majority of it, right? So, which is, if the nominal GDP is growing at 10-11%, how do you find companies which are growing at 20-25%, right? So, and one more thing, the percentage of small cap companies becoming multi-bagger were double that of percentage of large cap becoming multi-bagger. So again, the hit rate was also higher, right? So if you are a good stock picker, and out of the universe of 500-600 small caps, if you can find 20-25 stocks which are superior to the average small caps, your success rate can be much higher than that.
Got it.
Right? So that's, that's where you don't really need to go through, change in strategy at every point in time. If you just focus on these parameters, then you're able to find. Imagine like the smallest large cap today is 1 lakh crore.
Yeah.
Right? If that needs to go up 10x in 10 years, that will be 10 lakh crore. Right? That company will be in the top 10 or top 5 companies
Most
of India.
certainly.
What is the probability of that?
Yeah.
The smallest large cap cannot, become a 10 bagger.
10x.
It's mathematically impossible.
Yeah, almost
unless it's a
impossible.
completely outlier. So you need to find small caps which probably can become large caps. That's the only way to generate 20% plus returns. If you are not targeting that, focus on the large caps and get those 13-14% kind of return and be happy with it. Why take this additional risk, right? But if you are targeting 20%, then and if you're targeting that from the large cap, that's not possible.